Welcome to the weekly trend trader momentum strategy. I love this strategy. I've been trading the financial markets for over 20 years, and I know that this particular strategy comes up with some tremendous winners. You can make a lot of money in a short space of time trading momentum. But over the years, I have seen a lot of people try to explain momentum trading. Here's the angle that we're coming from here at the weekly trend trader. We're teaching you to trade the way the banks and the institutions trade. They trade differently from retail traders. Banks and institutions are in for the big money. So that's what we're going to show you. Today, we're going to set up the chart. We're going to show you exactly what's needed for trading momentum. Then we're going to show you some enormous wins that come from trading this strategy. Before we go any further, don't forget to subscribe, to like for the algorithms so other people can find our information, and also to share with your friends so that they too may want to build a supplementary income or even a primary income. Okay, so let's get going. For this particular strategy, what's needed? Let's build things up. First, we need to look at 2 years worth of price action. So we want a 2-year candlestick chart. Right, when we talk about candlesticks, some might not be familiar with what we mean. So in front of me here is a 2-year candlestick chart. The green candles are when the market closes up, and the red candles are when the market closes down. Let me explain a little bit more. The green candle opens here on a Monday, closes here on a Friday, trades to the high of the week, which is the top of the wick, and the low of the week, which is the bottom of the wick. Then the red candle is the opposite. On a week that closes down, we open here on the Monday, here on the Friday, here's the high of the week, and here's the low of the week. Next to those weekly candles, we've got two other significant weekly candles. These are called the high test bar and the low test bar. The high test bar and the low test bar are very significant because they tend to appear at turning points in the market. So a low test bar, we'll start with that one. The market opens here, trades down on heavy selling, reaches the low here, and then gets bought all the way up past the open to close on its high on the Friday. That's a low test bar. Testing the lows of the market usually shows a turning point when the market is about to move to the upside. A high test bar is the opposite. So the market trades at the high here, gets rejected from that high price with heavy selling, drops back past the open price to close on its low of the week, and that is called a high test bar. We've got our weekly candles on our chart. We understand what weekly candles are. What's the next thing we need to do to build the strategy? Well, let's go back to our chart. So we've got the 2-year price action. We've got the green and red candles signifying the weeks. We need to put on there next the 52-week EMA, an exponential moving average, 52 weeks. Why 52 weeks? Well, 52 weeks is a year. We want to know, obviously, what the price action is doing. What's the average over the last year? And the 52-week moving average helps us to see that. If the candles are above the 52-week moving average, then we're bullish. The market is moving in an upward fashion. If price action is, or the candles are below the 52-week moving average, then we're bearish and the price is falling. The other thing that we use in this type of trading, when we're trading momentum, is an RSI indicator, or a relative strength indicator. Notice here, when the market is at 80 or above, then the market is overbought on the oscillator. When the market is at 20 or below, then the market is oversold and we expect the buyers to step back in the market. And then we have the 50 median average line. So an oscillator, an RSI oscillator, goes between 0 and 100. 100 being the highest price and obviously 0 being the lowest. 80 is overbought, 50 is your median line, and 20 or below is oversold. But the beautiful thing about this when you're trading this way is that you'll notice that the RSI creates patterns. Sometimes you'll get patterns in the stock chart itself, sometimes you'll get patterns in the RSI. So just give you an example of that. If you look here at this first one here in October, you can see that there's a double bottom on the RSI and that the market makes a very big move to the upside. If you look again at about 3200, there's another double bottom. You can see that on the RSI and you can see that on the chart at 3200. The market again moves to the upside, but it quickly runs into resistance at 4200 where there's a double top. See, the price runs up to 4200, drops back, runs up to 4200 again to create the top, drops back, the market sells off. There's a double top pattern. And if we look on the RSI, it briefly pops above the 50, falls back, above the 50, falls back, and then we can see that the price action stays below the 50. So a market where the RSI is above 50, yeah, then that's a bullish price action, bullish market, market's going in an upward fashion. Price below 50 on the RSI, that's bearish. The market is weak. The market is usually in a downtrend. So let's look at these patterns a little bit more. I've mentioned the double top, and that's it here. Here's the example of the double top. Market runs up, hits some resistance, falls back to what we call the neckline, but it's marked here in blue, then goes up again, hits the same price, the sellers come back in, breaks that neckline, and creates the double top pattern. Triple top is the same thing, but it happens 3 times. Market runs up, falls down to that blue area, which is what we call the neckline, runs up again, falls back, runs up for that 3rd time, and the market sells off, as you can see denoted by the red arrow on our chart. Head and shoulders is a very similar pattern to the triple top, but just have a look at the variance. Market runs up the first time, drops back to this area that we call the neckline, marked in blue, goes up, makes a higher high, forming the head of the head and shoulders pattern, but then drops back to the neckline, runs up to the high again to the same pretty much symmetrical level as that first high, breaks the neckline, and we go into reversal. And then when we've got a double bottom, it's the repeat or the opposite of a double top. So a double bottom, market goes down, tests the bottom twice, breaks the neckline, off it goes to the upside. Triple bottom, market falls down, first time, second time, third time, hits that low, reverses, goes back to the upside. And then we have an inverse head and shoulders, where the market drops down, creates a lower head, drops back again. You can see the symmetry between the first low and the 3rd low, and the market moves to the upside. So let's go into the strategy now. So what we're looking for in the strategy, we're looking for multiple weeks of selling or one big candle of selling. So on the example I've got here, we've got red bar selling, red bar selling. Then the market goes down, tests the low, forms that low test bar that we spoke about earlier. First green bar. Now it doesn't have to be a low test bar. It's very, very helpful when it is, but we're looking for that first green bar of price action. When that bar turns from no longer being red to green, we jump in. We buy here at the open. Sorry, we buy here on the Friday at the close, and we put our stop below the low of the week. Then we go back and we look at it the next Friday. What's happened? We've gone up again. We buy another contract. We put our stop below the low of that second week and raise the stop from the first week up there too. Third week we come back, market's still bullish, market's still going. We're looking for 3 to 5 of these green bars in a row. Again, we get a green bar, we buy again, we put the stop below the low of the week. Fourth week, market's still going. We buy again, buy another contract. We put the stop below the low of that week, and we keep on buying up to 10 weeks. If you get 10 weeks in a row, That's absolutely fantastic. We'll talk about that later. But 10 weeks in a row, don't buy any more than 10. If it goes 11 weeks, 12 weeks, and you're very, very fortunate if you get that in a row. But it's that, don't buy any more. Just buy up to 10. But here, when we get this first red week, we take our profits. So here in this particular illustration, we get green bar 1, green bar 2 weeks, green bar 3 weeks, green bar 4 weeks. On that 5th week, when we come back, we see that the market is closed red. Either the stop, the low of that red week will take out our stop, or if it hasn't taken out our stop, we see a red week and we take our profits. So let's look at some actual charting examples of this. Before we go any further, if you haven't already, don't forget to subscribe, to like, and to hit the notifications bell so that you don't miss any more of this powerful content, the way that the banks, hedge funds and institutions trade. Okay, so let's go back to the chart here and let's look at an actual example of what we just talked about on the chart. So if we see here, back here, we look at August and we go 1 week, 2 week, 3 weeks of selling, low test bar, buy that bar, put your stop below the low. Second week, flat week. When I get a flat week like that myself, I don't add to it on a flat week. If it looks very, very flat like that, I don't add to it. I wait until the next week to see what's happening. Let's look at another example here. Look around October time. So we have these 3 bars of selling around September, then 1 bar up. We don't always get this right. So we get 1 bar up, we go, the next week it's down. However, look at what happens afterwards. There's on the RSI in October, there's a double bottom and a low test bar. And we go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks in a row. Absolutely fantastic trade when you get 11 weeks in a row. That's what traders live for. That is a super trade. You make a lot of money if you keep buying contract after contract after contract after contract for 11 weeks in a row. Then we have a big seller bar. Then we get a low test bar again. You may have another go at it. 1, 2 weeks. Market comes out, takes out the low. We're pretty much flat on that trade. But then if you look, we get this V spike right around January time. The market dips down and we say, yep, let's have another go at this one. So we buy it again. 1, 2 weeks in a row. Flat week, we don't do anything. Remember, first week we buy with our stops below the low. Second week we add to it, buy another contract, stops below the low. That third week, as we can see here, that third week is a flat week. Personally, I wait to see what happens the next week. Next week we go higher, buy some more, stops below the low. Fourth week, stops go, it goes higher, we buy again, buy another contract, stops below the low. Fifth week goes higher, stops below the low, and then that 6th week that comes there, we get to the top of the market. We don't know it's the top at that time, but the market comes in and takes out our stop, and we take our profits. Fantastic, another excellent trade. But if you look very carefully, if you notice that we hit the 80 level twice here, there's a very big, quite widely spread apart double top. Now personally, I would have a go, and I did have a go at this particular one, short it the first week, short it the next week. So when you're talking about a short, we're now taking money from the opposite side of the market. So the market, you place a stop above the high at 5,000, enter short, selling the market at 4,600. Next week, sell again, put a stop above the high. Next week, sell again, put a stop above the high, take profits on this green bar. Then the market runs up for 2 weeks. Then we have 1, 2, 3, 4 bars down. We form a double bottom. If you look at the April and May on the RSI, you can see a double bottom. And also when we look at the chart at 3,200, we can see a double bottom. Market runs off. We have another go at it then. Running into resistance now at 4,200, we see a double top. We realize this market is really in trouble. Double top is a major reversal pattern. you can clearly see the market run up to 4200, down, run up to 4200, down. Then as it comes down, red bar, red bar, red bar, red bar, red bar, the market starts to sell off. We take that trade and it's a fantastic trade. So you've got the idea of how the strategy works. If you look at the RSI, just on that final one, July and August, you can see there that you can see the market pokes above the 50, drops back, pokes above the 50 on the RSI, pokes back, and then the market stays bearish for the entire time that the market starts to collapse. It's absolutely fantastic. Yeah, 10 weeks. Beautiful. Celebrate that. Enjoy that. It will come. You'll get 3 to 5 sometimes, 3 to 5 weeks in a row. But when you do it, celebrate and enjoy that because it is one of the most wonderful. So here's an example of the market in China. We get a V-spike reversal after the 2 weeks of heavy selling here. 2 weeks of selling from 2400. We see the market drops back for 2 weeks. Then the market moves up to 2400. We get that flat week, as I said before. I personally would wait. Next week, we get a green bar. Buy again. Off that spike, I'm expecting some big moving price action here. So then we get another flat week. I would wait. Then we get green bar, green bar, green bar, green bar, green bar, high test green bar, and then the next week is green. So we get 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row, and then we get taken out by this bar that actually ends up closing up. So that's a lovely little trade there. Beautiful move off that V spike that happened in October. Then we fall back for another 2 weeks. Multiple weeks of selling. Here's our setup above the 52-week moving average. And we go again, 3200, green bar. Stops below the low. Second week, green bar. Buy again. Stops below the low. Green bar. Buy again. Stops below the low. On that fourth week, take profit. Again, if you look at the RSI, we get a double bottom that forms in the month of February. Right here, February, March, we get a double bottom. So we go again, 3400, green bar, buy, green bar, green bar, green bar, green bar, green bar, green bar, green bar. Lovely, high testing green bar, doji green bar. We take our profits right there. Fantastic trade. So as you can see, the strategy is very, very powerful. Remember, you must put your stops below the low of the entry week and move all stops up each consecutive week. So the more weeks that go up, the more you move your stop up. Each week you move your stop up. So that's the strategy. When do we not trade the strategy? Because people who are not professional traders think that traders are trading all the time. We're not. We're trading when their setup is right, when we get the market above that 52-week moving average or below that 52-week moving average. I'll show you one more example before we look at when we don't trade. Just look at this example here, 3600. The market's already in a downtrend. The market's gone down below the 52-week moving average. We get a double top here at 3600. If you look at the chart, hits the 50 line, gets that resistance at the 50 line, double top forms at the 50 line, both on the chart, 3600, here's the double top. On the RSI, at that 3600 level on the RSI, look at the 50. Yeah, the 50 median line, the market is bouncing off that, and then we go red bar, red bar, red bar. Now when we're taking a short, remember, we sell the market on that first candle, putting a stop above the high of the week. Second week, we sell some more, putting the stops, all stops, above the high of that week. Third week, it goes down again. We sell the market again, putting all stops above that third week until we get a green bar, then we take our profits. So that's another opportunity of when to sell the market and make money from the market. Fantastic opportunities here on this particular chart, even at 5200 where we have that double top on the 80. See that there? I think I forgot to mention that one at 5200. There was a clear double top at the 80, and we could take that 1, 2, 3, 4 weeks in a row. So very, very good opportunities when the market sets up and when we get these patterns on the RSI or on the chart. But as we said before, when do we not trade the market? Okay, let's look at this example here. So let's start from the very bottom. If we look at 24.50, we fall down there and we bounce and we come again. We get this green low test bar the second time we come down to 24.50. We bounce off that green low test. Here's a double bottom in place here. The market's been in a downtrend for a long period of time. We've got 2 weeks of selling coming into the green bar. Low test bar, beautiful setup. Green bar, 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 green bar. High testing, red bar, take profit, fantastic trade. 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row, and all we did was keep adding to our trade. Buy another contract, buy another contract, buy another contract, raise all stops to the low or below the low of the week that we keep on adding. Fantastic example. However, look at what happens to the market after that. Look at the 52-week moving average. Market runs up to 32.50, but the 52-week moving average is totally flat after that. Now, sometimes you'll see that on the market. It's a directionless market. There's no point trading a market like that because we want either a 52-week moving average that is falling, as we saw here, or a 52-week moving average that is rising, as we looked at on previous examples. On this particular example, the 52-week moving average is totally flat and we wouldn't buy this market. So we sit on our hands and we don't trade this market. Professional traders know when to trade and when to sit on their hands. Amateur traders think that you can trade all the time and then they lose money and give money back to the market because they're over trading. They're trading too much and they're trading at the wrong time. So one more very important thing about the momentum trading strategy. Do not trade the market, we've said all the time, but do not look at the market all the time. Only look at weekly candles on a Friday. Don't look at the market during the week. Let me explain what I mean a little bit more by that. So on a Monday, the market might move up. Tuesday, the market might move up again. Wednesday, the market might move down. Thursday, the market might move up again. Friday, the market could move up or down or close flat. But what happens during the week is totally irrelevant to the strategy. We do not look at the market during the week because what happens is we're trying to control our emotions in trading. And if we look at the market during the week, we could get emotional. The candle itself hasn't finished completing, and what could turn into a lovely up candle earlier in the week could have been a down candle, but the week is not finished yet. So we only look at the market on a Friday just before the close, perhaps 10-15 minutes before the close. Go and have a look at the market. Then we know we've got work to do. If we're in an uptrend and the candle's green, buy another candle, place our stops below the low of that week, all of our stops. But do not look at the candle during the week. Very, very important. I hope this has been really, really helpful for you. When you get out there, drop us some comments. We want to hear about your winners. We want to hear about when you catch 2 in a row, 3 in a row, 5 in a row, 10 in a row. Drop that in the comments to us. Don't forget to subscribe. Don't forget to like. Turn on the notification bell and share this information with your friends so that they too can take advantage. They can really use this strategy and make some serious money for themselves. Until next time, see you again.